So what this slide talks about is if you were to jump out of the market after the 20 worst days in the market in any time frame and then miss a certain number of days, what would the effect have been? So if you invested $1,000 in the market and stayed invested, that $1,000 over 25 years would become 4,803. But if you were to jump out and miss the best day following 20 down days, it would only be 4,304. And as those time frames
Wow.
go out, you see, like if you were to take your money out because things were bad and sit on the sidelines for and miss the 40 best days, your money would be less than what you never would make your money back. You'd be
Right.
450 out of 1,000. So, when people talk about getting in and out of the market, you've not only got to get out at the right time, like before the damage is done, you got to get in before the
Right.
good times come back. And, back to that idea of recency bias and understanding like how you're going to feel during those times, it's going to be the worst feeling to get back in when you should.
Right. And loss aversion is such a big thing, and it's, for most people, it's more important than gains. But what this chart is clearly telling us is even if you didn't, even if you missed the worst 20 days of down and you only missed one day of up, you still wouldn't be
You
ahead,
still
which is
hurt
kind of
yourself.
crazy when you think about it. So
Yeah,
the most important thing is making sure you get those up days, and the only way to do that is to stick with it.
yeah, yeah, yeah. Which um, a lot of times in those situations, the feeling is just to do something, just do something,
Right.
you know, and
Hmm.
and doing nothing keeps you over
Right.
here, you know. Um, yeah, and I like this one too to kind of go with that, back to the idea of when you're in a bear market, it seems like it's going to go on forever. It has gone on forever, and nobody made any money in between the bear markets. Then you look at this,
Right.
and so this just shows from 0% with the upside and downside of different market cycles. So let's just looking at the last, we had an 11 year bull market. Rest in peace, never forget. But it lasted almost
Yeah.
11 years and almost 11 years to the day. Um, 401% growth. So you would have doubled your money 3 times during that period
Yeah.
compared to the bear market that preceded it, the financial crisis, one of the worst, in history, and it was
Right.
down 57% for 1 year in that time.
Yeah.
You really can't compare, but we mentally lose that scale and that difference. And I don't know how many times I've heard people say something to the effect of, well, I lost everything in the financial crisis and I never made it back. Well, if you didn't make it back, there's a reason. You must have,
Right.
back to the last chart, you were one of those people that was trying to jump in and out, because if you just stayed
Yep.
put, all that damage would have been undone many times over,
Right.
you know.
Well, that's why it's so important from our end when we're putting together investment plans and allocations, that risk tolerance piece of we got to figure out what you're going to be able to
Hmm.
withstand, because if we overshoot and put everything into the market and you don't come back,
Hmm.
you won't come back if we have to take our money out. So that's why it's so important that we work and continue to work with creating that asset allocation that matches your risk tolerance and your goals, so that we make sure that you stick with it. I think
Yeah,
that
for
just
sure.
that behavioral finance piece that's so important. And when we're connecting that to goals and what's important to you, and a lot of times when we're doing that, we're figuring out, okay, what's the least amount of risk that we can take and still be able to give you the ability to do the things that you want to do, because that's at the
Hmm.
end of the day what this is all about.
Hmm.